All right. Cool. Thanks for the introduction. Nice to meet everyone over here. Right. I so I have a chat panel and a question panel that is open to monitor questions and messages that are coming through. I just want to perhaps get see can we do a quick test to see is everyone able to send the messages through. There should be a chat. You can either send it through the chat or the questions panel. Maybe you can see if you can just send a quick message over. Be sure to send it to the organizers only, so that I can see if I'm getting the questions. Yeah, could I just trouble you guys to try to send a quick message through? Okay, I can see people raising their hands. Um, yeah, I can see people raising their hands, but can you see if you're able to send any messages in the chat panel? You should be able to see one. Sorry, just give me a second. I'm just doing a last round of technical checks because I think I'll need the team over at IG to send me the messages. Okay, cool. I Benny, if you can somehow please allow me to see the messages because I can't see it. But
Okay, not to worry. So, if there are any questions in the midst of the webinar, so please feel free to drop it. And then I'm able to see everyone's messages. I'm starting to see the messages dropping in. Then we will see how
okay,
to convey it over to you in the midst of the webinar.
all right, okay, cool. Okay, I can see already see messages from Ken, from Manli. Excellent, nice for y'all to tune in for today's session. Feel free to send the messages through, right? We have good friend Benny over here who will be sending the messages, like literally screenshots of the messages, to me throughout the session, and I'll do my best to answer them. So the way we're gonna do this webinar is, I encourage you guys as the webinar is progressing, if you notice questions which you are there are parts of the webinar which you're not fully familiar about, just send the question through so that I can address it there and then, right? Because sometimes it's just missing that one part of the webinar where you might have like you don't understand something, right? And then if I continue using that term for the rest of the webinar, right, then you'll be like, what's he referring to, right? So yeah, it's better that I address it there and then, right? And usually at the end of the webinar, we hardly have time for questions, so do your best to send the questions over. All right. Anyway, without further ado, today's session is a IG exclusive webinar, the powerful 5-step reversal strategy. Now, a little bit more about me, the presenter. My name is Desmond Leong, CEO, founder of Rocket. Right. So, for a little bit more trading specific terms, I'm a prop firm trader. My team, 15 times, actually by now it's actually 20 times prop firm traders. Right. Past multiple prop firm challenges. Finalists for Best FX, Best Equity Research 2019, 2020, and 2021. All right. So this disclaimer, of course, take note, everything in this webinar is educational in nature. Nothing should be construed as investment or trading advice. So please do your own due diligence before you guys trade. All right. Um, of course, this is my certificate of recognition, right? I've passed a few more prop firm challenges since then, right? But yeah, it's, just to show you guys that I went through it, I passed it. It's one of these challenges which a few of you all might be familiar with. Just it gives you very strict criteria on what is required to pass, right? And once you hit those targets, you pass. I feel like it's a very good test for people to take to kind of prove themselves that they are able to trade well, right? And if there's anything that I want to share with everyone here is that you don't need um you don't need 20 years in on Wall Street with a master's in financial engineering to be a good trader, right? Instead, just take it from me, right? I'm pretty young, 35, right? I've been trading full time for about 8 years. Run a big team over here, right? We provide research, webinars, trading to many of the largest brokers, prop firms out there, right? And it's all about learning, right? I feel that in this day and age, is knowing what to avoid learning, because there's way too much uh, in the markets now, right? Everyone's teaching. There's smart money concepts. There's the ICT trader. There's Elliott wave. There's so many different kind of trading techniques, right? There's so many kinds of trading strategies, right? And most of the time is to kind of that's the funny thing about trading, right? The funny thing about trading is it's very different from the world of academia, right? If you think about it, when we were growing up, we have books to read, right? We know that if we read a textbook and it is there's a right answer and there's a wrong answer, right? We know that the more we read, the better we do. But that world of academia is very different from the world of trading, right? In trading, you can read the right stuff and you can read the wrong stuff. You can learn the right stuff and you can learn the wrong stuff. It's a bit scary in the sense, if you think about it, right? You can spend 1 year reading a particular trading strategy and you realize that the guy has no idea what he's talking about. And you actually spend 1 year of your life like learning the wrong stuff, right? So there's a difference in trading, which I really, really want to emphasize is that you need to learn how to avoid learning the wrong stuff. And today's session, very generously sponsored by IG, right? I'm not going to sell you a course at the end of today's session. There's no special there's no special deal ringing of. I think if you've been to some of these other seminars out there, there's no like ringing of a bell to tell you guys to get some course or something. I'm holding nothing back to share with you the trading strategy I use, and of course I teach my team. We've passed so many prop firm challenges. We've done so well in trading. I'm holding nothing back in today's session. Today's session will teach you about the reversal style of trading which we use, right? There's a total of 4 webinars that we're doing. I'll be trying to cover as much of it as possible in today's session. Okay, and of course I'll break it down in future sessions. Now, if you so that I can get a better gauge of the room, if you can share with me how long have you all been trading, right? How long have you all been trading? And if you trade mainly technical or fundamental analysis, right? Then I can get a better gauge of the room, and perhaps I can adjust what I'm teaching, some of the jargons I'm using, to better communicate today's lesson over to you all. So feel free to send it in the chat. Feel free to send it in the questions, right? I'll take a look at it along the way. Yeah, but please do let me know. How long have you all been trading? Primarily, is it technical fundamentals? Are there any particular strategies that you guys use? Please send it over. Now, let's move on to the agenda today. All right. So the agenda, what I'll be teaching about, the first one. Okay, you're able to see my screen. Is there a way that I can yeah, I'll draw a bit over here. Okay, so the first thing I'm going to look at is reversals or breakout. Which has a better risk to reward? In trading, it comes down to two things. Are you playing a reversal or are you playing a breakout? If you think about it, right? You're either playing in the, breakout, for example, if it's bullish, or reversal is bearish. In trading, it just comes down to those two things. I'll be explaining, what a high probability reversal zone is. Key considerations, when you're looking for these entry levels, right? Stop loss, take profit, super duper important. I'll be sharing a little bit about it on all the factors to consider, and stay until the end. We got a really good indicator giveaway and a promo, IG promo, right? So be sure to stay until the end. All right, moving on. Reversals versus breakouts. Okay, very simply put, this is a bullish reversal. This is a bullish breakout. Okay, bullish reversal means that you found a very nice level of support. You're waiting for price to come down, 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 down here, right? And then make that bounce. The same thing with the bullish breakout. You find a key level, right? Find a key level, and you're waiting for price to go to this level and then make a breakout. Okay, so this is what I mean by bullish reversal, and this is what I mean by bullish breakout. Okay, so what does that mean? There are pros and cons for each, right? So when you're playing the bullish reversal, right, you usually have a pretty good risk to reward. You catch the bounce, you put your stop loss maybe somewhere below, you get a very good risk to reward. The bad thing is that momentum is usually against you. Momentum is usually against you, right? Meaning that you have all this momentum that is against you, and by the time you reach here, right, you're hoping, it's like you're catching a falling knife, right? You're hoping that there's this little reversal that happens over here. Okay, the same thing with bullish breakout. The momentum is with you, right? Many of you guys are bullish, are breakout traders. And the thing about breakout traders is that once price reaches this level, right? If you technically have all this momentum, bullish momentum that is behind you, that could allow you to see a nice breakout. Okay, the bad thing is that there are often fake outs, right? Meaning that price might reverse, and each time if you think that price is going to break out and it reverses and it reverses, that's how you get stopped up quite often. So that is the problem, right? Reversals is good because it has good risk to reward momentum, but it's bad because momentum is against you. And for breakouts, momentum is with you, but you usually, are the casualty of many fake outs. So how do you combine the best of both worlds? Right? How do you combine the best of both worlds? This is how I would do it. Right? I would use what we call the overlap. Right? The pullback and the overlap. Very, very useful. Okay. So what you're looking for first is that, true enough, yeah, you're looking for this little level, right? You're waiting for price to reach a resistance level. It makes the reversal. It makes a reversal to show that it respects this key level. All right. Once it makes the reversal, you're waiting for it to make the breakout. So this is a part where it finally makes a breakout, but you don't look to enter the trade yet, so to speak. Only when it makes the breakout, then you're waiting for the pullback. This is the level where you're looking to play the bounce. Why? Because in this case, momentum is with you and you generally have good risk to reward. So you're playing a reversal over here, but you have the broader bullish momentum, which is kind of taking you upwards. Okay, so that's a key thing that you're looking for, right? You're looking for two patterns. You're looking for two patterns. The same thing with a bearish overlap. First, you're looking for price to come all the way down and make a bounce. This shows that, all right, I respect this level. This is a key level that it bounced. Now I'm gonna reverse, 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 reverse. I'm gonna break through it. This is a very important thing. It needs to break through this level. It then needs to make a bit of a pullback, and only over here do you get in on the trade to play the reversal down. All right, so this is a part where on the smaller time frame over here, on the smaller time frame, you're playing the reversal, but on the larger time frame, right, on the larger time frame, you're playing the momentum. You have momentum with you for the larger time frame, and you got the reversal, the benefits of a reversal strategy with you on the shorter term time frame. Okay, so this is the concept between that I want to implant, right? When you're looking for this kind of setups, right? To actually look at both the short term and the long term. All right. Now, let's move on, right? Let's move on to the concept of high probability reversal zones. What we'll be looking at doing is this thing called stacking of probabilities. Now, all right, just get a drink. when we're trading, all right, when we're trading, what we're actually looking to do is to have the highest chance of being right. Correct? You want to have the highest chance of being right, and that essentially is what I call stacking probabilities. Now, when it comes to stacking probabilities, what I want to emphasize is that you want to stack probabilities from different camps, from different studies. Let me explain the technical version first. Okay, the technical version of this is, some of y'all might be familiar with RSI. We got the RSI, we have the stochastic, right? We got the stochastic, and we have the MACD. Okay, we have these three: stochastic, RSI, MACD. Now, the thing about these three is that they are all oscillators. They're all oscillators. So you can have RSI that is overbought, meaning that it is all, it's all the way down here, right? RSI is all the way down here, ready to make a bounce. Stochastic also, sorry, I mean oversold. Stochastics also oversold, is all the way down here, is ready to make a bounce. MACD, maybe it's down here, it's going to cross over, and it's going to go up. All of them, all of them are saying that you should buy, right? That is bullish, right? Looking at a bullish signal, it would give you, so most people say, I'm going to load the RSI, the stochastic, the MACD, maybe the alligator, all the different kind of oscillators, right? But the problem, right? The problem with that is that it is not one, it's not three indicators telling you that price is going to bounce, because we know that oscillator is low, maybe the RSI is all the way at the bottom, maybe like below 10%, below 15%, it's going to bounce, right? Or rather, the studies tell us it's going to bounce. The problem with this is that it's not three indicators telling you it's going to bounce. It's actually one type of indicator that is telling you to bounce, which is the oscillators. So you might derive a false sense of confidence because you thought that you were stacking probabilities. You thought that you were stacking one, two, three, right? To me, if you have six, you stack six probabilities, super, right? It's very good. But the problem is that in most cases, if you stack stochastic, RSI, MACD, whatever other oscillator, you're actually only stacking one probability over here. Okay, now let me just erase my drawings. So it is like what's the word for it? What you want to do essentially is to stack probabilities from different studies. Stochastic, oh sorry. So stochastic RSI might be this, the oscillators. Then you might stack a probability from support and resistance. Then we might stack a probability from Fibonacci. Then we might stack a probability from Elliott wave. Then we might stack the probability from correlation. Then we might stack the probability from maybe something, divergence, right? Which uses oscillators, but it's a different version of it. But this is where you're stacking multiple probabilities because you're taking it from different camps, right? Oscillator camp is one, right down here. Then of course we got a support and resistance camp, harmonics. Then we have divergence, we have correlation, right? You're taking it from different studies, and if all of them are telling you that price might bounce, then you have a high chance of being correct because you're stacking the probabilities of multiple different studies, right? It's like you want to get as much of an unbiased opinion as possible, right? For example, if we are all like familiar with like cars in Singapore, right? If you went to a BMW, right, showroom, you ask the BMW salesman, what is the best electric car right now, right? If he says, oh, the best electric car is a BMW, you'll be like, huh, it's a little bit biased, right? You go to Mercedes, what's the best electric car? They say, it's a Mercedes, right? And they're all, you get a little bit suspicious because they're all, the you feel like it's their opinion is very biased. But if, right? So it's very difficult to make a decision then, right? But if the guy in BMW says, the best electric car, I think is a BYD, right? If the person in Mercedes say, you know what, best electric car right now, I'll give it to BYD, right? And then you go to Toyota, they're like, yeah, BYDs are pretty good guys, right? So if more of them are saying like, oh, BYD, right? BYD, right? So you then get multiple sources to kind of triangulate on what is the one best decision to make. Like, what's the one best electric car to buy? What's the one best entry to take when it comes to trading, right? So what you want to do is you want to triangulate. Of course, maybe more than three sources. You want to take multiple sources to find what is the one best level, one best decision to make. It's very difficult, of course, if like RSI says is going up, but stochastic no Fibonacci says it's going down, right? Elliott wave says it's going up, but maybe harmonics say it's going down, right? So if you have too many conflicting signals, then it's a little bit more difficult to arrive at a decision. And you probably the thing I would do is I would err on the side of caution and say, all right, this particular trading setup doesn't look like, there's if you're a fan of Star Wars, it'd be like there's a disturbance in the force, right? It doesn't look like the stars are lining up, right? So that's what you want to do. You look for the stars to line up. Let me show you an example. Okay, now we have this is what I call a pullback resistance. Okay, we have a pullback resistance. Let me explain the psychology. If you see this pattern, is super, it's very good. Now let me explain why. Okay, when you see this pattern over here, when price bounce one time and it bounce a second time, now price comes down, and guess what? When price comes here, a whole bunch of people would think that is going to bounce. So what do you do when you think price is going to bounce, right? What do you do when you think price is going to bounce? Well, you buy. Now you buy, and what happens is price goes down. Price breaks through the level which you thought was going to bounce, and it's going down. And what is going through your mind now, right? What's going through your mind now when price is dipping like this? You know, the traders who initially bought over here, they'll be like, oh man, I should have put a stop loss. I should not have bought. I'm regretting my decision. Should I continue trading? There is no light at the end of the tunnel. Oh man, this is terrible. But price starts to reverse. It starts to reverse a bit. It starts to reverse a bit. And it's like, oh, there is light at the tunnel, at the end of the tunnel after all, right? It's coming back. Oh, there's hope in this world. It's slowly, slowly coming back. And what happens when it finally reaches here? The people that were holding on to this initial trade, thinking that it was going to go up, the people that were initially holding on to this long trade, they're going to close off their trades. What are they going to do? They're going to sell, right? They're going to sell their position. When they sell their position, what happens, right? Price gets pushed down. That's the psychology behind a pullback. In case no one has ever explained it before, there's a psychology behind a pullback. It's because all those people who are holding on to their positions, thinking that price might actually make a bounce from this key support level, right? They are now liquidating that position, they're closing it off, and that influx of position from these people over here, plus the people who are naturally pullback traders, all of them jumping in to sell over here naturally pushes prices down. That's the psychology of the pullback resistance. Okay, you can do the same for pullback support, but this at least explains why you should be looking out for this particular kind of pattern. Look for one big bounce, two big bounces gives people an even better sense of security. And then when it finally comes down here, look for the breakout. Don't try to get in over here. I feel like it's a little bit risky, but this breakout is what you're looking for. The more brutal, the better, because the people who are holding on to their positions and praying for the markets to go back to their entry level, once it comes here, they'll liquidate so fast, right? It naturally adds a good amount of momentum to push prices down. Okay, that's the pullback setup. Now, we got the pullback. Now we got the channel. All right. So we got support and resistance. Now we need to consider momentum. Okay. Let's consider momentum now. Now with momentum, all right, what I look for a channel is you naturally look for one, two touches at the top, two touches at the bottom. That is the minimum amount that you need for a channel. You need four touches. All right. You need two at the top and you need two at the bottom. Okay. Then you have a proper channel. You have two at the top, one at the bottom, doesn't count. You need minimally two top, two bottom. You have a channel momentum now. Okay? Channel momentum, lo and behold, it lines up right at where the pullback resistance is. Okay? So I have one, which is a support and pullback resistance, and I got two now, which is the momentum. Okay? Moving on from here. Guess what? Oh, Ichimoku cloud. The Ichimoku cloud can actually be quite complex, right? You can have all the different lines with the Ichimoku, but I tend to have a filtered version of the Ichimoku where I remove all of it and just leave the cloud, because the cloud is a good indication of momentum, right? For anyone who doesn't know how to use Ichimoku cloud, quite simple. Look in the sky. If you see heavy clouds, looks like it's gonna rain. If you see very light clouds, it's not so strong, right? The bigger the cloud is, the stronger the resistance, the stronger the support, right? So these are big clouds over here, right? Big clouds. Notice price reversing, right? You see price kind of fighting a bit with the clouds over here. Now, of course, this is the perfect example I'm drawing for you. It's not always the case. Price could just as easily go in, out of the moment of the Ichimoku cloud. So it's not to be used by itself in isolation. You use it to stack probability. All right, you use it to stack probability. So yeah, look at this, right? You got the clouds. Price is reversing from the clouds. Naturally, when you're using the Ichimoku cloud, a little tip I have is to look for it where the cloud needs to be sizable, right? This is what I mean by sizable. This is what I mean by not sizable. This is really thin. You need a big amount of cloud that you're looking at. Imagine you're flying a plane, you're looking at a whole bunch of thick clouds, strong turbulence, right? Disturbance. That's what you want to look for. Because the nice thing about Ichimoku cloud is that it forecasts into the future, right? So the bars end over here, but the Ichimoku cloud forecasts into the future. So if you forecast that there's a nice amount of cloud over here, right? Nice amount of cloud over here, you know that price is going to hit some turbulence. Okay. And naturally, when you're looking to sell, look for clouds that are above you. When you're looking to buy, look for clouds that are below you. Okay. So looking at this, we have the pullback resistance. That's one element. We got the channel, two elements. We got the Ichimoku cloud. We got three elements over here. All right. Now, of course, remember everyone, if you have questions, please send it along the way. I'll do my best to answer them. All right. I'll do my best to answer them. Now, so we got three elements over here right now. Okay. What's going to happen next? Fibonacci. All right. Um, I guess if there's one tip that I'd like to share with people regarding one of the few leading indicators, one of the few leading indicators in the world, I would say, is the Fibonacci. Okay, take it from a guy who, in my earlier days, I was doing research for a French research firm, right? We advise the largest banks and hedge funds, Brevin Howard, Nomura, you name it. We do the technical research for them. One of the amazing things I learned when I went into that space, right, is that they use Elliott wave a lot, and Elliott wave is all based on Fibonacci. The problem with most indicators out there is that they are lagging. Okay, a moving average is lagging, an oscillator is lagging. One of the few indicators out there that's actually leading is the Fibonacci. It forecasts in advance where the markets might reverse, right? So if you haven't, we might do a topic on this later on, but if you haven't, it's one of the indicators which I feel you should really put the effort into learning. It is very, very difficult to learn because it's very difficult to get it right, but it's worth putting some effort into learning, right? Some, like, coming from me, like, one of the indicators that really helped me in trading. Fibonacci, 23% retracement. You start at the top, you draw a Fibonacci trend line all the way to the bottom, and you find that price might reverse off this 23% retracement. I won't dive too deep into how to use a Fibonacci retracement now because it's a massive topic by itself. You have Fibonacci retracements, extensions, expansions, and projections, right? Different ways to draw all of it, different theories, very difficult. We'll cover it in another webinar. But guess what? 23% retracement happens to line up with the Ichimoku cloud, happens to line up with the support and resistance, pullback resistance, happens to line up with the channel. Pretty amazing so far. Moving on. The fifth one, right? We have the, so many questions, right? Okay, I'll answer these questions later on, right? Yeah, Benny, don't feel free to just send me screenshots, right? It helps me so I can actually see too, right? So the next one, Fibonacci projection. Fibonacci projection requires 3 points: 1 point, 2 point, 3 points. So you're taking 1, 2, 3, and you project upwards, right? 78.6% projection, that lines up very nicely over here, and a shorter term Fibonacci retracement, 61.8%, that lines up over here. Now, this might sound like a totally another foreign language to you, but it's okay, right? I just need to tell you, when it comes to me identifying reversals, this is the technique that I use to kind of go through it. All right, so don't worry if you don't understand it. This next 4 webinars is where we'll be learning this together. Okay, so for where to go, right? So Fibonacci projection and shorter term Fibonacci retracement, very important. You need long term. One of the tricks to trading or analysis, what you realize is that it benefits to analyze both the long term and the short term, right? The 4 hour and the 1 hour, I usually go based on the rule of 3 or 4. So if I do the 1 hour, I also look at the 15 minutes. If I look the 4 hours, I also look at the 1 hour. 4 hours to define the trend, 1 hour divide by 4, 1 hour will define the entry. If my 1 hour is a trend, divide by 4, 15 minutes is the entry. All right, don't go too crazy because honestly, the 1 day chart has little impact on your 5-minute time frame. Okay, the 4 hour chart has little impact on your 1 minute time frame. You don't need to go too far. All right, so sorry, I just gonna digress a bit over here. If I have the 1 day time frame, I have the 4 hour time frame, right? I have the 1 hour time frame, right? I have the 15-minute time frame, and I have the 5-minute time frame, right? Rule of 3 or 4. If you're trading on the 5-minute, use the 15-minute as your trend. Because let's face it, your 5-minute will not be affected by your 1 day time frame. If there's someone who tells you to analyze all the way top down, all the way like this, he doesn't know what he's talking about, right? So if you have a 15-minute time frame as your entry, use the 1 hour as your trend. If you have 1 hour time frame that you're trading on, use the 4 hour as your entry, as your trend. And if you have the 4 hour time frame which is your entry, use the 1 day. as your um, as your um, as your trend. All right, I see some questions. How to establish a support level when spot gold is diving nonstop due to whales flipping, right? Identify the support level, right? What you look for are the pullbacks. Okay, I'll be showing you later in an example. Okay, how do you determine if it's not a false breakout? I'll be showing you how you. Okay, to determine if something's actually not a false breakout, I have an entire webinar on it. You need to use correlation. That's a trick. Use correlation. Highly strong, highly positive, and highly negative correlation is the trick to that, right? Sorry, that is the answer for Daniel Tam. Right, I missed the earlier part when the speaker mentioned there are some tests or certification one has to take, blah, blah, blah. Could you let me know? I'll let you know about this later on. It's like prop firm challenges. You can search up about it. Could you talk about when the breakout goes too far? Let's say on um, okay, let's say on daily time frame on a stock, it might break out and go up to if coming down. Is the breakout too much or should it look along when it goes back to a line? In other words, when price breaks out before coming back. Okay, there's a really good question by Andres. Not sure I pronounce it. Anders. Um, the question revolve around, I would say, let me go to a like this chart. If a breakout happens over here, his question. Oh, have I frozen? Am I frozen? It looks like I'm frozen. Let me disable my camera. Turn it on again. I'm just saying, is everyone still able to hear me? Okay, hear me, right? I didn't just lose connection, right? Okay. All right. Cool, cool. Okay. So Andres had a very good question, right? When a breakout like this happens, let's just say you found a nice little level here, and the breakout happens. His question is, how far is too far? If it comes down to here, if it comes down to here, if it comes down to here, is it too far? My answer to that, the further the better. What you don't want, right? What you don't want is price breaking out and it reversing right away over here. This makes it very ambiguous, right? Meaning that if you have a big level over here where price has bounced multiple times, when the breakout finally happens, the further it is, the better. If it breaks out like this and it reverses, man, that is very tricky. I wouldn't consider an entry over here, right? It's too close. You want to look for what I call significant swings. You want to look for price to come down further, let people go on an emotional nightmare roller coaster, right? To take prices all the way down. The further it is, the people who are originally holding onto this long trade are in a more volatile position emotionally because the majority of traders they hold on to their losses. So the further it is, the stronger the pullback would perform. So if it comes down to here, you can imagine that the original people that were holding on to here, man, they're not only holding on, they are depositing more funds so that they don't get margin call, right? Or they're getting in again, they're worrying, they're trying to do everything. When it finally reverses and it comes back to here, right, the reaction will be stronger. So the further it is, the better, the stronger the reaction, right? So I'm more concerned about, I more prefer it to, the breakout is stronger, right? Then the pullback is stronger. If the breakout is like a little bit wishy-washy over here, you're not too sure, might not be strong. Question from Rosenland. Which Fibonacci levels do you consider to be most important? Well, strictly speaking, right, the right answer to this is actually none of the Fibonacci levels are important, right? It's the combination of Fibonacci levels that are going to be important. The golden ratio of 61.8 is not going to be stronger than the 23.6, right? Naturally, for me, if I had to pick, I would pick the 38.2, 50, 61.8, and 78.6, right? Those four. 23.6% is not so strong for me, more because like price has already kind of, it's not such a big reversal movement, right? It's worth considering. but I don't consider 13%. I don't consider 88%. Right? For purely for Fibonacci retracement, 23, 38, 50, 61, 78. Okay, won't dive too much into that. Now, let's go into here. So notice, right, how we have the first one, pullback resistance over here, pullback resistance, channel momentum, right, nice little channel, long-term Fibonacci retracement, 23.6%, short-term Fibonacci retracement, 61.8%, Fibonacci projection, 78.6% Fibonacci projection, Ichimoku cloud over here. Now, interesting thing, by themselves, they might not be that strong. By themselves, a strong Fibonacci retracement like here might give you a 30% chance of being right. Okay, channel momentum, right? Such a nice strong channel might give you a 15% chance of being right. Long-term Fibonacci retracement, not so strong, maybe 10%. Short-term Fibonacci retracement, not so strong, 5%. Short-term Fibonacci projection, not so strong, 5%. Ichimoku cloud, not so strong, maybe 10%. By themselves, they're not so strong, but you add it 30, 45, 55, 60, 65, 75. If you add it all up, right, your probability might shoot up to 75% of being correct, right? Hypothetically, in this example, right? So notice by themselves, they might not be good enough setups. Just trading support and resistance by itself is never going to be enough, right? Kind of figure if it was good enough, people would have done it by now, right? So put resistance and then combine momentum. Notice I'm combining from different studies, right? One is classical support and resistance. One is classical momentum chart patterns. One is classical, not even classical, it's more advanced, like a leading indicator, Fibonacci retracement. Then I take a shorter term Fibonacci retracement. Then I take a Fibonacci projection. And one more is from, of course, the Japanese himself, the Ichimoku cloud, right? Different studies to classify momentum, to classify support and resistance, to classify leading indicators, lagging indicators. I'm taking it from different sources, right? So if they all agree with me that price is likely to reverse, then I have the best chance, right? Then I have the best chance or a high probability of getting reversal. Notice, not absolute, but a high probability. So that's what we want. We want a high probability. It's never just about being correct or wrong. It's how much a probability do you have. All right. Now, my then hypothetical entry, right? Sell entry, stop loss above a recent high, take profit before a recent low, right? That is correct, Kev, right? Based on this example, we only short at 0.6. You're not wrong. It's correct, right? So I'll explain a little bit more on stop loss and take profit, being very wary of time. We only have a few 10 plus minutes left, right? Let's talk about risk to reward. Very important thing that I want to teach you all. Please participate with me over here. Okay, Benny will send the answers over. Now, if we had a bag, right, and you're going to put your hand inside the bag, notice there are 5 red, right, and there are 5 blue balls. Yeah, 5 red and 5 blue balls. I'm going to give you, right? I'm going to give you, or rather, you have $100. You have $100 and you're going to bet, right? What are your odds of getting one red? So you are looking to pick up a red ball. You only get to play once. You only get to play once. And you're going to bet. You have to bet something. You have to bet something. How much will you bet that the ball you pick up is going to be red? All right. So this is $100 you have. Can you all please participate with me? Let me know how much will you bet that you're gonna get red? Remember, you have to play, so you can't just sit this one out, right? You can only get to play once. How much would you bet, Benny? If you don't mind trouble you, if you could show me some of the answers that might be coming true.
Sure, no worries. I think we have just one response that is coming in at the moment. So this is from Fisher, who answered 2 in 10.
2 in 10. So no, but you got $100, right? So maybe I forgot to put. You have $100, which are which you have to bet that you're gonna get rid, right? How much would you all bet on it? Okay,
Okay, we are starting to see around $50, some
fifty
$5
dollars.
and $10.
Okay, so $50, $10, $5 very conservative. $50 can see that you know that your odds are 50-50, right? So you're gonna put like 50% chance you're gonna get it right. So I'm gonna put $50 on it. Fair enough, you might win $50, right? Because you know your chances of winning is like half, correct? Now, if we were to change this, and now we have this case, I give you and let you know there are 9 red balls inside and there's 1 blue ball. You have to bet on the same that you're gonna get red, right? And you have the same $100. How much? And you only get to play once, okay? You only get to play once. How much would you bet that you would get when you put your hand inside to pick up the ball? You would get red, right? If you can participate with me over here, right, just to get an understanding on risk allocation theory, or rather risk management theory. Benny, do we have any answers coming in yet?
Okay, we're looking at the moment, majority are saying at $100.
$100. Wow, you got okay. I'll probably put a full $100 too, right? Most of y'all would put in a little bit more than $5, put in more than $10. You put in more than 50. You put in 100, and that is the concept behind risk allocation that I want to share with you about. Most people think that trading is binary, meaning that yes or no. Is it going to be, do I take a trade or do I not take a trade? That is not the case. In most cases, is do I not take the trade? Do I take the trade? How nice is the trade? Is it 6 red balls, 7, 8 red balls, 9 red balls? Rarely ever 10 red balls, right? But it's like you're stacking the probability. If you have 6 red balls inside, you'll be like, yeah, odds are still in my favor. I don't mind putting in maybe $60, right? But if you've got 9 red balls, that means like in the setup I just showed you, everything is lining up nicely. You would naturally, it would make sense that if the probability is in your favor, then you allocate more risk, right, to that trade, open a larger lot size, so to speak. So that's the concept behind risk management, which I want you all to grasp, right? Is that if a setup looks nicer, right? Not all setups are equal. It's not yes or no. It's no, yes, and how much of a yes. Okay. Now, moving on from there, right? The whole concept of trade management is actually quite wide. It's not as simple as entry, stop loss, take profit, which is what most people teach you. Most people teach you entry. Some hardly even teach you stop loss. But your entry is as important as your stop loss, is as important as your take profit. All are equally important. Risk management comes in the part over here. Where is your break even? Idea and validation. Where partial stop loss, trading stop loss, position sizing. All of these are important to make you a profitable trader. Most people only focus on the entry, right? Stop loss and take profit would then allow you to determine what's your risk reward. Every loss that you, every risk-free trade or every loss that you prevent is an additional win in your bag, right? So the approach to trade management is not as simple as what's your entry. I'm going to put my stop loss 10 pips away. I'm going to put my take profit 10 pips away. It's not like that. The amount of effort you put into determining your entry, you need to put the same amount of effort to determine your stop loss and your take profit. That's the trick. All right. More on that in a trade management session next time. Okay, so moving on. Um, my one tip that I'll probably share with you guys is that when it comes to trading, always, as a rule of thumb, if you found a major resistance level, put your stop loss slightly beyond so that you give your trade a little bit of space to breathe. And if you find a major support level, your take profit is always slightly before essentially get out of the trade before it reverses, because most people, they look at a trade and it happens so often, right? Reaches price reaches right about your take profit, you're so close to it, and then it reverses. If it ever happened to you before, you'd be like, oh my goodness, right? The markets are against me, right? Me in particular, right? The markets are looking at me, and there it has a personal vendetta against me. But that is not the case. It's classical support and resistance, right? What happens is that you put your stop loss, you put your take profit beyond a key level. So when price is just about to reach it, it bounces. Or your stop loss, you must put it, you don't put your stop loss over here, because price might come and fight the this key level. It always tends to fight, right? And you will be caught in the crossfire. So if you see something happening, you see a fight happening on the streets, right? What do? You stand further back, right? You don't just stand in the middle of the fight, because someone might throw you a punch and hit you, and you'll be like, oh, what happened? I was just caught in the crossfire. You take a stand a distance away, right? You take your stuff and then you run away. That's what you do when it comes to trading. When you notice that price is approaching a key level where a fight is going to happen, what do? Take your profits, right? Say, I'm going to clear up my table, right? I'm going to take my stuff and I'm going to stand at a distance, right? Think about the analogy whenever you see when you want to put your stop loss and take profit. Give your stop loss a little bit of breathing space, put your take profit slightly before, okay? Now, this is just a simple example that I want to show you, right? So, we got a nice support level over here, right? We got a nice support level over here, and imagine if you've ever been to Baby Pips or Forex Factory. Everyone's sharing trading strategies over there, or maybe it's one of these YouTube videos that you watch. The moment, the moment you see any trading strategy, say use a fixed 100 pips stop loss, 50 pips stop loss, I can tell you, the guy doesn't understand what he's trading about. Okay? Never, ever use a fixed number as your stop loss, because of course different assets have different kind of 100 pips on euro dollar is different from 100 pips on pound yen, but you should use it as a gauge, not as a definitive stop loss. Because look at this, if I had a strategy that says use a 100 pip stop loss because 100 is a nice number, this strategy doesn't work. The 100 pip stop loss happens to line up right above my nice support level. What did we learn? Stop loss beyond, take profit before. So our stop loss is supposed to be a little bit further away. Okay, what happens when this happens, right? We think that price is gonna go up, break up, but it reverses, right? Instead of going up where we initially thought, it comes all the way down, and look at this, it spiked down here, stopping me out, right? It stopped me out and then it bounced up. Why did that happen? Simple, right? I put my stop loss right before a key support level. Don't just use 100 pip stop loss as like a level. You use it as a gauge, right? As a reference. So if I knew 100 pip stop loss was there, maybe I'll put my stop loss down here, which could be 110 pips. It's okay if I lose 10 pips, right? It's better that I give myself that buffer of 10 pips, additional 10 pips, than to get stopped out entirely, right? So when this happens, what happens next? Of course, yeah, that gives us a buffer. Let me show you this another example, right? We think the entry is going to be here, and I'll take profit. Notice, I'll take profit is at a major swing low. What I always say, if you notice this is a big swing low, put your stop loss slightly before. So put your take profit before. Okay. Now we do a little bit of Fibonacci projection. Notice that the 78.6% Fibonacci projection is there. I move my take profit from here. I move it up a bit. Okay, because what happens? Price comes all the way down, touches your take profit, and then it goes up and never sees the light of day again, right? So what I'm looking for, right? If I had placed my take profit down here, where it was initially on the extreme point, a lot of you guys like to do that, right? You like to put your take profit on an extreme level, the peak of a swing high, right? Why? Because it looks nice. What happens is that when price comes down to this level, there's a fight that is happening already. Get out before the fight happens, right? So you put your take profit slightly before. Of course, Fibonacci is very good for fine tuning it, but yeah, it helps you get out of the trade. All right, it helps you get out of the trade, and of course, you bag your full profits. You might sacrifice the 10 pips over here, right? Doesn't matter because you would have lost it anyway if it didn't hit your take profit. Okay, now I would touch a little bit more on top three mistakes because I'm being very wary of time over here. First mistake: don't set a daily target. Okay, a lot of people see some online guru, they say treat trading like a business. You got to have your daily targets, you need to have your weekly targets, right? Make 1% a day, make 10 pips a day, make 100 pips a day. Now that is bad advice, because if you think about it, right? Question thread. A lot of questions. Okay, well, so many questions, I will answer them in a bit. Okay, now why is, imagine it's the weekend, it's a Saturday, and I say, hey guys, today our target is 1%. You will look at me and you'll be like, oh, you fool, the markets are closed. How can you get 1% on the weekend when the markets are closed? It's not moving. Now, I can use the same logic when the markets are not moving in your direction. When the markets, you know, when the markets are, there's not much liquidity, there's not enough volatility, the markets are ranging, there's no trading opportunity, right? If there's no trading opportunity on the weekend, you don't trade. If there's no trading opportunity on a weekday, you don't trade, right? It's the same thing, right? If you have 80%, if you hit 0.8% profit in a day, it's 11 p.m. at night, right? And you're looking at the clock. Oh man, I need to hit 1% profit. I need another 0.2%. Why? Because I place this arbitrary target on myself. I need to treat this like a business. I need to make 1%, right? And you start looking at your 1 hour time frame. It's like, man, 1 hour time frame is not telling me anything. I will go down to the 15-minute time frame. Oh, it's not showing me anything. I will go down to the 5-minute time frame. Then you find a setup. You take the trade and you lose money. You're back to 0.5% profit. You're like, oh man, now I need to go and trade again. I was so close to hitting my profit target. Take another trade. You go to 0.2%. You take another trade. You go to negative 1%. And you're like, I should have just stopped for the day. Right? Why? It's because you compromise on your entry. You compromise on entry to hit an arbitrary profit target, daily target that no one in the world forced on you. So don't set a daily target. Okay? Just don't set a daily target. Anyone who tells you to set a daily target, I would argue that they don't know the nature of the markets. They don't really know what trading is about. You can't trade when the markets are closed. You can't trade when the markets are not moving. You can't trade when there's no opportunity. Why force yourself to put yourself into a pressure cooker moment to chase the last bit of profit in a day, within the last 30 minutes of the day? For what reason, right? Trading is hard enough. Trading profitably is hard enough. Trading profitably with unnecessary targets, super tough. No point. Next thing, don't master one instrument. Most people think, oh, I'm going to be the master of euro dollar. I'm going to focus on euro dollar. I'm going to trade euro dollar. Euro dollar is my zone. The truth of it is that the markets move in tandem. Euro dollar go up, dollar franc go down, right? Euro dollar go up, dollar index go down. Aussie dollar go up, Kiwi dollar go up, and Kiwi yen might go up, right? Markets move in tandem, and it tells you, it gives you hints. Someone will ask previously, how do you avoid false breakouts? How do you know if your breakout is happening, right? So quite simply, if you were looking at euro dollar, right? Euro dollar, EU, and dollar franc, you see, right? Dollar franc. They move in opposite direction. When one goes up, the other goes down. They are strongly negatively correlated. When euro dollar is over here and it's down here and it looks like it will make a bounce. Looks like you're hoping that it'll make a bounce. That means on dollar franc, price is over here and you're looking to make a reversal. If you use correlation and you master one instrument without looking at anything else, that means you're not looking at dollar franc, which could give you the hint that if dollar franc was at that exact moment, right? If dollar franc already make a breakout, that means it's going to go up. That means this trade on euro dollar is unlikely to work out because euro dollar going up and dollar franc going up is unlikely because they're negatively correlated. When one goes up, the other goes down. So if you master one instrument, you blindside yourself to this. You need to see, look at the clues, see is there a disturbance in the force, right? See if the stars are lining up. If euro dollar goes up, dollar franc should go down, dollar index should go down. All right, so don't master one instrument. Take time to master the correlated basket of instruments that affect the instrument that you want to trade. It doesn't mean that because you want to trade euro dollar, you need to go learn about dollar ZAR, or dollar peso. That's not the case. If you want to trade euro dollar, look at the basket of instruments that affect euro dollar and master those instruments. Okay. The third mistake, no coaching. Invest in coaching, invest, of course, in perfect cases like this, maybe IG sponsoring, very generously sponsoring a webinar. Invest in this education, right? Always continuously learn and improve yourself. All right. This goes without saying, of course. So yeah, continuously learn and improve yourself when it comes to trading. Just one piece of advice, right? There's enough education out there, especially with AI now, to learn the right kind of analysis. Don't stay away from, I think, yeah, educators who charge an arm and a leg, selling you a trading course, right? I don't sell trading courses, but I feel like it's I personally would avoid them, right? Try it out on yourself first, right? Or attend the next 4 weeks of webinars that we'll be doing with IG, right? It teaches you everything you need to know to be a good trader. The second link is not yet out, but I think Benny will send it to you guys. And on an ending note, thanks for staying all the way through. I will answer some questions now. Andres, what time frame do you mainly trade on? I will assume you find more opportunities on lower time frame, but opportunity get positive. So Andres asked me what time frames I usually trade on. I usually trade on the H4 time frame using the D1 time frame as my momentum, as a larger time frame. At most, I'll go to H1 time frame and use H4 as like my larger momentum, right? I don't. So, oh man, I'm going to digress again. Okay, so the reason why I don't go onto the lower time frames that much is because the lower time frames have what I call more vulnerability to the known unknowns, right? A big news event, like the non-farm payroll, on the 5 minute chart, it looks crazy, right? The bars go up and down and be like, wow, big movement. Go and find that same non-farm payroll. Go and look for it on the H4 time frame. That bar is going to be just like any other bar. So what throws traders off is the known unknowns. You can do all the technical analysis, all the probability, everything looks nice. Like in the previous example I showed you, I have 6 elements lining up and I'm about to take the trade. But if I was on the 5 minute chart and the trade happened when a big news event like the non-farm payroll happened or Donald Trump decides to say something, right? Price spikes up, down, bam, I'm out. I'm vulnerable to the known unknowns. So on the lower time frames, the 1 minute, the 5 minute, even the 15 minutes, you're very vulnerable to that. So you might have got all the probability lining up, but because you're on the lower time frame, you could be very easily taken out by something like this. You know it's coming. You know a news event is coming, but you do not know the outcome, right? So that messes up with the probability game that you're playing. So I personally like to stay on the H4 time frame because I have more immunity. Non-farm payroll, it's okay. Let's let it happen. We got the CPI, it's okay. Let it happen, right? I know that it won't affect my larger strategy that much, right? Another question. What's your thoughts on trailing stop loss? useful, but I wouldn't use just simple trading stop loss. I would trail based on trenches. Like once it crosses key level, then you move it. Because if you trail it just based on simple like trailing stop loss, there's no math behind it. It's just a random number that you're picking. Daniel asks, how many pips is slightly above or below? Right, wrong question, right? Because what you want to do is on the 1 hour, my answer for you on the 1 hour time frame, on the 4 hour time frame, on the 5 minute time frame is very different, right? Just eyeball it, right? Give yourself maybe, yeah, just you got to eyeball it based on the time frame that you're on. Look at how long the wicks tend to be, right? If the wicks tend to be about like this long and stuff, then put your stop loss a little bit above the wick, right? Like that distance of the wick, because that is the amount of volatility that tends to happen before markets close in and settle in on the price. Or you could use ATR. Use ATR as a gauge, right? Maybe I would use like once you hit that level, maybe 0.2 ATR, 20% ATR, average true range, just to give yourself that bit of buffer. Thoughts of entering trade at your stop loss levels. Anders is asking, what about entering trades at your stop loss levels? No, don't, unless it's a very, very good setup. Every trade should be independent of each other. Rosalind asking stop loss on high slash low or on close, right? My answer to that is stop loss is beyond a key level. So it's not on the high, it's not on the close, it's beyond a key level. So it should be beyond the high and beyond the low. Anders asks again, right? Thoughts on using break even exit. So if your profit is 50%, but your reverse and goes back there. So break even, don't use it when your profit just because you reach 50%. There's a psychology and technique on when to use break even. That usually happens when price is at the deciding level. You are usually what happens, you break even is partial profit. You take some profits off the table and you're moving your stop loss to break even, because what you're essentially telling the market is, I am not sure if price is really going to go all the way in my direction. There's a risk level where it might come down, it might stop me out, right? The odds are still my favor that I might be correct, right? Personally, for me, I hardly even use break even because I play from one key level to another key level. Using break even means that you're playing from one key level beyond another key level, which is why you want to protect your position, right? My trading strategy doesn't use break even, because break even, you could argue, is that you're just closing part of, you could actually, if you're taking that much risk off the table, you might as well put it in your pocket, right? And then take another trade. More on that in a trade management session. All right. Now, indicator giveaway. So I have built one of the best MT4 support and resistance indicator, which I'm gonna give to you guys, right? Very good indicator. This is how it looks like, right? You can select the time frame. You can toggle the strength. It shows you where the overlap, the swing lows and stuff. Allows you to toggle multiple time frames like this, right? Shows you where the key levels. Super good. Is of course, is sponsored by IG today. So as long as you fulfill the promotion giveaway, you will get access to this. You'll be enabled for your IGMT4 account. These are the use it in your trading just by itself. Will be able to help you find support and resistance levels very well, right? You should, after this webinar, you should get an email, right? You need to register your interest in the email, so be sure to check it out. Be sure, if you of course, help me to fill up the survey too. All right, there's a survey after this webinar, right? It'll let me know, of course, how you found the webinar, right? You know, if I think 1 or 5 stars, if you find it lousy, let them know. If you found it great, let them know. And of course, some other topics that you'd like me to potentially cover in the future. Deposit at least $1,000 in your account, make one qualifying trade, and the deadline of the promotion is 4th of June. So I think you got a good about 2 weeks. All right. So you can reach out to marketing.sg@ig.com for more information. Right. And yeah, go share with them what topics you'd like me to potentially cover in the future. We're going to have 3 more webinars. 2 more webinars. 3. I think 2 more webinars we'll be doing together. Sorry, not 3. Including this will be 3, of course. We're doing 2 more webinars. If you'd like me to cover more webinars, let them know. If you found this webinar good, do leave me 5-star reviews, right? If you find it bad, 1 star is fine. I promise I won't hunt you down, right? But yeah, at least let them know why if the webinar is not to your liking. All right, so I'll be passing the time now back to Benny. Thank you everyone for staying throughout today's session. I hope you found it useful, right? Do tune in, keep a lookout for the next two webinars, right? It will give you a much better. I actually start to drill in a little bit more into the technical stuff, how to get these setups, how to do the Fibonacci, how to do the support and resistance. And hopefully by the end of it, I'll teach you everything that I've learned in the last decade, right? So that you can be a profitable trader. Okay, just stay. I'll pass the time over to Benny. Do remember, please, to fill up the survey later on.
All right. Thank you so much, Desmond. I think that was a really amazing session. I even for me, I really enjoyed the session on the risk allocation. And then also want to take the time to thank everyone for
Thanks, everyone.
being very responsive. I think everyone really had a lot of hope. I do hope everyone also had a lot of fun. Sending out your responses, and we do I think what Desmond has also shared, he already gave off the teaser that we will actually be having a few more sessions with him. So thank you so much for the overwhelming number of questions also. So we will definitely collate over the questions, and then we will pass it over to Desmond to see in the next session we will address some of the questions ideally perhaps after before we kick off the next topic. Okay, so if I could have everyone to bear with me for a few moments or so. I'll just go in depth again on this exclusive best support and resistance indicator. Now, so at the end of the webinar, we will have your attendance already. So we will be sending over a couple of emails, which we will reiterate the guidelines and the mechanics again of how will this promotion work. So if we look at step 2, basically if you are an existing IG account holder, so you can immediately move on to the step 2, which would be to deposit at least Singapore dollars 1,000 into your account, and then you just need to simply make one qualifying trade. To then once we do the tracking at the end of 4th June 2025, then we would be unlocking the indicator over to you. For those that do not have an existing IG account, so please do not worry. This is the time to take the opportunity to also create an IG account, to which that once you have the account already, then you can move on from step 2 onwards to step 3. Now, if there are any also further queries, I do believe there are some people who are tuning in from the YouTube live stream. So not to worry also, if we may kindly also ask for you to reach out to our marketing.sg@ig.com email, then please also kindly provide us your email, and also provide us your MT4 account number if you do have an existing MT4 account. So once again, like if there are any queries with regards to this exclusive promotion, please feel free to reach out to marketing.sg@ig.com, where we will address over the queries that will come with regards to the promotion. So to complement also, just a quick reminder again. Okay, so just a quick reminder again for those interested in trading with IG, apart from the exclusive indicator by Desmond, uh, opening an account is very straightforward. So whether you are ready to trade like, okay, so once again we have this welcome bonus where you for this is mostly applicable for people who do not have an existing IG account. So simply once again, you notice that you will need to open a new account, the same mechanics as the exclusive indicator. If you deposit at least $1,000 into your account, and then you start trading, you are also entitled to a welcome bonus, which will be directly credited into your IG account upon creation. Okay, so I'll probably leave it here for a few seconds. If you would like to find out more about this welcome bonus promotion, you may scan the QR code. Okay, and then moving on, for those that, if let's say you would like to know more about opening a live account, we have also provided a few QR codes over here, which we will leave it here. Alternatively, if let's say maybe you would like to start off with a demo account and use some virtual funds, then we have also the QR code there for you to take a look. Okay, I'll just leave this here for a few moments again. Okay, so as Desmond mentioned, so we definitely love to hear your thoughts on today's session, and your feedback will definitely help us to improve and continue to deliver valuable content. So, if I may, could I please take a few moments of your time before you leave to scan the QR code, and please do help us to fill in the feedback form before you leave. So, this feedback form will really help us to assess like what are some of the subsequent content which you would like to see from Desmond or even from IG in the future, and also do let us know like if there are any certain sites or technical feedback that we can have. Maybe if we want to have a better platform for our webinar conducts, or if let's say there are any other aspects which you feel that we can improve on our side or even on Desmond's side, then this is the moment for you to scan the QR code and then leave a feedback for us.
Hey Benny, you there?
Yes. Hi Desmond.
Okay. Yeah, yeah. All right. Just seeing if whether the webinar ended. Yeah.
No worries. So we are actually starting to see a couple of more responses. Then let's try to have a few more. I'll continue to keep this feedback form perhaps up till around 8:24. Then from there.
All right. Okay. Thanks so much, everyone. All right. Please go leave the review so we know how to better like craft future webinars. All right, guys.
I have a question from Sheet who so give me a moment and then I will share the. Okay, so if you'd like to take a look at the welcome sign up promotion again, so here is the QR code for your reference. Okay, I'm gonna leave it there for maybe around 10 more seconds. Okay, so we've begun to see quite a number of responses, so I think we will begin to close off the session. So once again, I'd like to thank everyone for joining us for this session, and also really want to thank you all for a very wonderful engagement. I think we do hope that you all had a really good session to engage with Desmond, and we will definitely be looking to have more of such engagement sessions where we will get our attendees to also answer some questions which our guest speaker will also provide in our session. So with that, I will be closing this webinar now, and then would like to wish everyone to have a very good evening, and we will be looking forward to see you all real soon in the next upcoming sessions.
All right, thanks everyone. See you guys. Keep a lookout for your email for the next webinar. Bye bye.